All right, let's talk about a topic that every single future CPA has got to nail down cold: manufacturing overhead. I know, it sounds super technical, but really, it's just a classic story of expectation versus reality. We're going to break down what happens when what a company thinks it's going to spend doesn't match up with what it actually spends. Let's get into it.
So you ever plan a party, right? You make a budget, you think you've got everything covered, and then the final bill comes in and you're like, whoa, where did that come from? We've all been there. Well, guess what? Businesses deal with that exact same headache, just with a lot more zeros at the end.
And think about it, a company can't just wait around till the end of the month for all the actual bills, like electricity, rent, you name it, to finally roll in. They have to price their products and make decisions on the fly, right now. To do that, they have to rely on a little bit of financial fortune-telling. They have to estimate.
And this is their crystal ball, the predetermined overhead rate. It's basically a company's best educated guess. They calculate it before the year even starts, and they use it to assign or apply those estimated costs to all the products they're making. It's their game plan. So this sets up the big showdown, our main event, the estimate versus the reality. Let's meet the two key players in this story.
In one corner, we have actual overhead. This is the real deal, the final, no-kidding credit card statement number. It's what the company actually spent. And in the other corner, we have applied overhead. This is our budget, our estimate, what we thought we were going to spend based on that predetermined rate.
Okay, so where do these two numbers finally come face to face? It all happens in one special place, the manufacturing overhead account. The best way to think about this is like a temporary holding area, a clearing account, where we dump both numbers so we can see how they stack up against each other.
Now let's get visual and throw this into a T account. This is where the truth comes out. This is where we see if our budget was on point or way, way off. First up, reality hits. The company's actual overhead costs for the period were $95,000. In the world of accounting, we put that on the left, or the debit side of the account. That's the final bill.
And what about our estimate? Well, over the same period, using our predetermined rate, we applied $90,000 of overhead. We put that on the right, or the credit side. That was the budget.
And here you can see them, side by side. On the debit side, our actual costs, 95 grand. On the credit side, what we applied, 90 grand. You don't have to be a math genius to see they don't balance.
And that's the whole point. We've got a $5,000 difference. The debit side is heavier, which leaves us with a $5,000 debit balance just sitting there in the account. Now, this leftover 5 grand isn't just some random number. It has a very specific name in accounting. It's the official verdict that tells us exactly what happened with our estimate.
Because we have a debit balance, we call this underapplied overhead. It literally means what it says. We underapplied. We didn't apply enough overhead to our products. Our $90,000 budget was too low compared to the $95,000 reality.
Just so you see the whole picture, what if it was the other way around? What if we'd applied, say, $100,000, but only spent $95,000? Then the credit side would be heavier, and we'd call that overapplied overhead. We went overboard with our estimate.
So here's the golden rule you have to burn into your memory. If your actual costs are bigger than your applied costs, you have underapplied overhead. Simple as that.
Okay, LSCPA study hack alert. For everyone grinding for the boards, here's one you'll want to save. Just remember this. A debit balance means you have a deficit, and a deficit means you underapplied. DDU. Debit, deficit, underapplied. Got it? Good. All right, so we've cracked the case. We have a $5,000 underapplied balance, but we can't just leave it sitting there at the end of the year. We have to do some accounting cleanup and get that account back to zero. Now, accountants basically have two moves they can make here. The first is the simple, fast way. Just dump the entire balance into cost of goods sold. Done. The second method is a bit more work, but it's more accurate. It's called proration, and you spread that balance out between a few different accounts.
But you know what? Whichever method is used, the end goal is always the same. Get that manufacturing overhead account down to zero so we can start the next year with a clean slate. Okay, let's bring it all home with the LECPA briefing. This is our rapid-fire review designed to lock this knowledge in your brain not just for your next quiz, but for the long haul. This is your 3-year retention plan right here.
So here's what you absolutely have to know. Why do we estimate? To make decisions on time. If actual is greater than applied, it's underapplied, that's a debit balance. If actual is less than applied, it's overapplied, a credit balance. Remember the hack? Debit is a deficit, meaning you didn't apply enough. And listen up, this is a huge one for the boards. Underapplied overhead increases your cost of goods sold. Overapplied decreases it. I promise you, you will see that again.
And that's our deep dive on under and overapplied overhead. We've officially solved the mystery. And remember, accounting is so much more than rules and numbers. It's about learning to read the financial story that a business is trying to tell. Now you know a little more of the language. Keep digging.